All right, folks, it's a beautiful Sunday, and I am putting up the second video for this week. So, my goal of doing at least one video for the week uh, has been met, more than met. Make sure you check out my other video. It's about how to make fish tacos, delicious grilled fish tacos, and they're great and easy. So, check that out. But today's video is not going to be about that. One of my passion is about personal finance, so things like budgeting, financial planning, investing and saving for retirement or for something else. It doesn't have to be retirement, but retirement is usually what I focus on. So it's a big passion of mine. So this talk today, it's going to be a little long, but I think it's going to be helpful to a lot of people who are wondering about this. And what I want to talk about today are IPOs and what they are and whether they're good candidates for your portfolio. So IPOs, it stands for Initial Public Offering, and they're basically stocks that have made their first appearance on the stock market for the public at large. So, something that was a big IPO this year has been Snap, which is the parent company of Snapchat. You also have Beyond Meat, you have DocuSign, you have a bunch of others, but that's usually IPOs. Lyft, Uber. There's one that's being talked about in the news called Rework. That's IPOs. They're companies that have made it through the private equity investing stage and are now going to be available for the public. And a lot of them are companies that people have certainly heard about, and some may even be very excited to invest in just because they're a well-known brand. And that's why they're kind of dangerous. And I want to talk a little bit about them. In the past, what has happened with private equity investors is that they tended to watch over their investments very carefully and make sure that the money is being well spent and the company is doing the best that they can and making the right decisions so that when they do go public, they have a really good chance of being a successful enterprise. Doesn't guarantee it, but it gives them a leg up. So, the private investor, decades ago would have an interest in doing that. It's their money, right? They're taking a lot of risk and they want to ensure that it does well. So what happens is that they will sit on the board of directors, they will be very involved in the management of these companies, and for the most part, that worked out well. What has happened in the last decade and a half is that private equity investors have really taken a step back from kind of watching the investment and letting the founders of these companies really be in full control. And that's dangerous for the little guys like you and like me, for example. Just because it doesn't serve our interests when these initial equity investors are not watching their own money. And there's many reasons for that, but one of the main reasons is that these private equity investors are seeing competition from sovereign wealth funds and others. So they've adjusted their model to give more control to the founders of these companies that they're investing in, rather than make sure that the governance and all of that is done right. And that's created a lot of problems. You may be wondering, why are they doing this? It's still their money. Why don't they watch as carefully as they did in the past? And the main reason is that valuations for companies that are taken public has just really skyrocketed to crazy numbers that for the most part doesn't make sense, but it works out for the private equity guys. They're really just looking for these unicorns that make it big, and then they can make it big on their investment. But it doesn't matter to them what happens after that stage. If the company goes public and the stock performs horribly for people like you and I, doesn't matter to these equity investors, these angel investors. Let me give you an example how this would work. So let's say that you have, a pile of money, $10 million, and you're looking for investment in private equity. You would divide this into, say, 10 piles, $1 million each. You put it into 10 companies, and you let them go. And at some point, you're going to take one of them public because the other 9 has failed. You've lost all your 9 million. But this one company that's left is building a brand, is getting news, and people know them, so they get taken public. And what happens is that your initial 1 million investment has returned 15 times, 15, 20 times. That's not unheard of at all. They call these guys unicorns, right? You've certainly heard the term. And that's probably low, on the low end, frankly. But you can get 15, 20 times. That $1 million investment is now worth 15 to 20 million. So on your initial 10 million investment, you've either made 50% or double your money. And that's just a really simple, low end case. A lot of times, these companies will return many multiples of that, and the private equity guys will do really well, after a short period of time. And that's why they do it. And short, I'm saying 3-5 years, something like that. But for them, they really don't care if the other 9 that they put their money in has gone bankrupt. And they really don't care if this one company that they're able to take public tanks after the stock is issued to people like you or like me. As long as they've made their money, they're happy. So that's the environment, that's what's going on. But the problem you have when you have founders of company leading their operations but with very little oversight is that there could be all kinds of governance problems. So one of the ones that we've heard about lately is Rework. So it's led by this guy, I think his name is Adam Newman, and they're talking about how they should price the IPO when they put it on the stock market for people like me or like you. And initially they were thinking just a couple of weeks ago that WeWorks could be worth some $47 billion. But in the last couple of days, they're talking valuation that has gone down to the range of 10 to 18 billion. That's just ridiculous. If you really think about it, they're just pulling numbers out of thin air as values for these companies when they sell it to the public. And that's crazy. If you take the low end of that valuation, 10 billion, that's a drop from 47 of 75%, 80%. It's just crazy. And this is why we're getting fleeced. So the problem with WeWorks is that apparently Newman is self-dealing. And what I mean by that, and I didn't know this has come out pretty recently, you can find it in the news. As CEO of WeWorks, they offer co-working spaces, which are really cool. They're modern, they're in nice locations. When you look at the pictures and the amenities they offer, it's a place that you would want to work. As CEO of something like that, he would want to make sure to minimize the rents he's paying, the operating expense he's paying, so that he can maximize profit for the corporation. Well, it turns out that he's also the landlord that is renting properties to WeWork. So on the other side of the deal, he's buying up commercial properties and becoming the landlord on that side of the deal, where the interest for him personally is to maximize the rent that he's charging so he can make more money personally at the expense of the corporation. This is raising a lot of concerns for people, and rightly so. So there's a lot of flack going, towards them, and this is what's causing their valuation to have problems. But this is a huge, example for me on why the average person should not even consider IPOs, unless you're willing to do the legwork and study and research and all of that, and have convinced yourself it's a wise investment. And if you do that, then you don't have to listen to my advice. But if you don't have the time or the expertise, this is a classic example of why you're going to get screwed with IPOs. So I'm going to put up a chart of recent IPOs that have come out and what you would have done if you had put some money into them. So on the list, you'll have some names that you certainly recognize. Snap, the parent of Snapchat, Lyft, DocuSign, Beyond Meat. So you can see that most of these companies are clustered in a very tight group, right? And then you have Beyond Meat that's like way up there, 3.3, 3.5 times the initial IPO price, which frankly is a complete anomaly. You're not going to usually see that at all. So even if you include Beyond Meat in that group and you look at the group as a whole, if you had put some money in there, you would have gotten about 18% on your investment, which sounds great. I love to take 18%, right? But year to date, the S&P 500 has returned 20%. So even with the outsized performance and frankly the abnormal performance of Beyond Meat, it's still underperforming the S&P 500 market as a whole. If you were to take Beyond Meat out of the equation, the group that's left would be barely making a 1% return, so barely positive. And in fact, you can get a higher interest rate than that at some internet banks on cash balances. So overall, IPOs are not a good investment for most investors. My advice, and this is the punchline really, is that if you are investing for the long term, your best bet, unless you're willing to put in the work, is to buy an index fund, a broad market index fund, something like the S&P 500, and make sure that the fund that you're buying or the ETF you're buying has really low fees. Set the switch to reinvest dividends and just leave it alone. You'll do so much better than 99% of other strategies. I may be exaggerating that 99%, but it's like high, 90 at least. Anyways, that's my rant, advice, whatever you want to call it, on IPOs. I know that a lot of people have an interest in IPOs because they're sexy, they're attractive. I mean, when you listen to companies' names that have come out as IPOs, like Lyft, Groupon, Uber, Snap, things like that, they make you want to invest in them, right? But for the most part, they don't work out. It's very rarely that they do, and it's more luck than not, and that's not how you wanna invest. Anyways, enjoy your Sunday. It's a long video, but I hope it makes sense for you. Later.